We will discuss here in this. First we will see what is foreign exchange, why there is a need of the foreign exchange. As the globalization happens, there is a movement of trade or services from one country to another. We buy Harley Davidson, send our textiles to the other countries, so there is a need of a common currency, a common platform, so that everyone is agreed upon for the buying and selling amount, because the amount is nothing but a revenue generation. The amount, it's all about money. Only the money is involved, then the buying and selling happens. So as all the countries have their own currencies, so there is a mechanism needed to have a very sound system, so that the currency can be exchanged from one country to another easily. How this currency exchange can took place? So the pioneers of great thinkers thought this, that we will take one currency as reference and we will compare all currency with this, and this reference is the dollar, because it's the highest valued money in the world. That's why we have taken dollar. So we represent dollar with all the currencies. So with this we start our topic. So the first, Indian Forex market. In the Indian Forex market, as we already learned that what is market. The market is where some buying and selling took place. So the Indian financial market, Indian Forex market, is nothing but the buying and selling of the currencies. It's simple, and it is done through the lumps mechanism management system. The lumps is nothing but a liberalized exchange rate management system. These lumps are applicable to all the banks we are working. I also took training foreign exchange, so I have seen how these currencies swap and how the online platforms, every 4 seconds the amount got changed, how this works. So it's a very great mechanisms the RBI implemented to buy and sell the currencies of the particular countries. So in the buying and selling, there is a quotation. For, let's say, in the computer system you get two options, buy or sell. So these buy and sell are differ countries to countries. We follow the indirect quote. There is two types of the quotes, the direct and the indirect. What are direct? The direct quotes is in terms of rupees you are representing dollar, and indirect means in terms of dollar you are representing rupees. So you have to keep in mind, this is direct and indirect arithmetic. Till 1993 we have followed the direct quotation, but after 1993 we started following the indirect quotations. Now the next concept is cross rate. Let's say, as I told you that everything is measured in terms of the dollar. Later I have to make a payment for the BMW. BMW is a German made, so we have to pay it in euro, because they will accept euro. The legal tender is euro in Europe. So how we can do that? Let's say 1 euro is dollar 1.5 and $1 is 67 rupees. So what India will do, what a person in India will do, they will buy the dollar with the rupees, and once they buy this dollar, now they can buy with the help of dollar, they can buy the euro, or making a relation with the euro or rupees, but we are going to euro with the help of dollar. So this is a cross rate. So every time whatever the question is given, and if they ask you to find the cross rate, then you have to find like this, that euro will be given in terms of dollar and dollar will be given in terms of rupees, and you have to find the exact rate. So we will solve one question in this, so that it will be a clarity to you. Let's say a person came with 5 euro in some of the European banks, and they want rupees, Indian rupees, for buying the cotton textile product from India. If you visit Amazon not the Indian ones, but the foreign, there is a payment of dollar. So if you give amount, what will they will cut the exchange rate amount, or they will take the equivalent exchange amount in terms of rupees and they convert it, and they do it intrinsically. I ordered one shirt from Colombia, so in this I just did it to experiment to see how this works. So I paid it in a payment. They took some charge, the margin they took to exchange the rupees into United States dollar. So they did, and they took the order and they imported it through the ship, and after 15 days I got the product, and it's a very nice one. So that's the thing, that's the application of the foreign exchange. So let's say a person come with the €5 and they want to buy a cotton shirt from India. So the $5 they will give to the European bank, and this European bank already has dollar or rupees reserves. Already they have some reserves with them. What if they don't have the reserves? They will tell this customer to wait, and they will take this euro, they will convert this euro into dollar, and with the dollar they will buy the rupees, and that's how the system works, and it will be credited to his account, so that if he goes or visit India or buy some cotton product from India, he can directly give it to the from the debit card or the card he is using. It's got credited, the Indian rupees got credited in his account. This is how the system works. The foreign exchange is a market. I told you it's a market. So there is a buying and selling of the product. So there is a one representation. Let's say €1 is equal to dollar 1.318090. So since you are a banker, you will take everything as a banker's perspective. It will be very easy. So this is a buying. Who is buying? The bankers are buying. This is nothing but if you extend this, you can write this like this, 1.3190. So this is buying, this is selling, and since you are a banker, you are buying at this rate and sell at this rate, and the difference of 10 is your margin. This is what the bankers are making profit through these businesses. Since RBI regulate this foreign exchange, so they do not allow everyone to do this business. Banks are allowed, or some financial institutions are allowed. So as a banker, let's say someone came to buy dollar with his euro. Some customer came, so he told you what is the rate going on. You will tell that. If customer wants to sell, then it simply means that bankers want to buy. So customer say that I want to sell €1. What is the rate? Then you will tell your buying rate, because you are buying. Then you will tell the ratio is 1.3180. So he agrees, he buys that. So he will give you €1, and you gave him the dollars. So you have in your reserves euro. As I told you, foreign exchange is a market. It runs similar kind of the share market. In the shares, we have the options to buy today, we have the options to buy 3 months older, we have the options to buy 6 months later. We have many options. We have call options, put options, but we do not need to go into depth. But since if you want to buy some dollar, and there are also some purpose that lots of people are buy or sell the foreign currency just to make profit, not to buy anything from the foreign markets or to invest somewhere. They just do it to make profit, because there is a speculation in that, and wherever the speculation is there is a profit or loss mechanisms. So people enjoy doing this, taking risk. So there are some terms used in the foreign exchange market is cash or ready. So some persons buy some dollars. So if the amounts got deducted from his account and dollars allocated to him is nothing but a cash or ready. Since it happens the day when the request happens, so it's a cash or ready. The next term is TOM. This is for tomorrow. The settlement or everything which like the deduction of amount of the dollars in their demat accounts or other kind of accounts whatever used in the foreign exchange is the term tomorrow is used. Now the next is spot. Spot is the day after tomorrow. It means let's say the request for dollar happens on some T days. Let's T be today. I just taken the acronyms, and it will be settled before T plus 2 days. Here we are taking T plus 1 only. Here let's say if the cash ready is T, then it's a T plus 1, then it's a T plus 2. The tomorrow the spot rate. This spot rate is the actual dealing rate. Means in India or any other country you will more often than not see this mechanism spot as frequently used to buy or sell the foreign currency. The next term is forward. Forward is more than T plus 2. Let's say after 3 months you want to make payment to someone for the goods you purchased or for the speculative purpose. Let's say that today the dollar cost is 60. A prediction, you just think that after 1 year the dollar would be 70. So what you do, you buy this dollar today with the cash or spot on the cash or spot basis, but you will sell this dollar after 1 year. You already do a contract which is called a forward or future contract. That's why the name forward. You want to sell after 1 year, so you did a contract. After 1 year you will sell this which is a forward rate. So more than T plus 2 is the forward rate applied. Now the concept of premium and discount. Since I told you in every 4 seconds the market fluctuates, so the currency amount got changed. So let's say at 10 AM $1 is equal to 67 rupees, and let's say at 1 PM $1 becomes rupees 70. So the 3 rupees increment is nothing but a premium. And if it's at 5 PM $1 becomes 65, then this is discount. Now very important thing should take into concern when you solve the questions. Let's say the question is 1 euro is equal to United States dollar 1.318090. So this is buying or bid rate, and this is nothing but a sell or offer rate. As a bank's perspective, see everything as a banker's perspective. So here in the questions it will say 1 month forward, and they give you some values like this. So whenever there is a decrease from left to right, you take it as a discount. So after 1 month, what is the value? You have to reduce this much amount from this because it's a discount. If it were a premium, then you have to add this. Let's say after 3 months, the amount is 74. Go from left to right, it's increasing, so it's a premium. So if you want to find after 1 month, then you have to subtract this 35 from this one, 32 from this one. And if you after 3 months you are getting as premium, So 70, 74, you have to add 70 in this, 74 in this. So this is how it works, and it will help you in solving the. Now as I told you that people use this for the speculative purposes, we will see how it can be used for the speculative purposes. Let's say one person, let's the 1 euro is equal to $1.5. Okay, how person use this, we will see the examples. Let's say in European countries, the rate of return for any investment is 3%, but in United States the rate of return is 6%. So the person of European countries, they want to make profit in United States market by investing in dollars into United States, so that they get 6% of rupees. So what they will do, let's say 2% is there, both have 100 euros. This is a financially sound, let's say it's you who is a financially sound, you know what is the importance, and you know what is the importance of rate of returns. So it's you, and let's say it's some of your friend who is not in banking, who is not that financially sound and doesn't have knowledge of the rate of returns and all. So he invested in European market. What he's getting 103 rupees. But since you are financially sound, you know the importance of rate of return, or you understand what is rate of return and you understand what is exchange rate. So what you did, you invested, you buy the dollar through this euro. You are getting $150 through this 100 euros. You invested this much amount in the American market and you are getting 6% of interest. So after 1 year he is getting rupees not euro 103, and you are getting $150 plus 6% of interest. So you are getting 159 after 1 year. Now since after 1 year the maturity comes, now you have to exchange it with a euro amount. So what you will do, you have to divide it with a 1.5 so that it will become in euro. So you will find that you are getting 106 rupees. Your friend your friend is getting 103, but you are getting 106. This is the power of having a financial knowledge or having knowledge of foreign exchange. So he is getting profit of rupees 3. Now you can ask that why for rupees 3 why you are doing so much of thing. The investment is not done of 1 euro or 2 euro. The investment are done of millions of euro, millions of dollars. So the market experts or the speculators do this every day to gain as much as knowledge, as much as profit they could take out of it. So this is so I think I have discussed all the basics. Now in the next we will solve different kind of questions, so that you have a knowledge, you have a glimpse that what kind of questions could be framed through this. So that's it. Thank you.